A warm welcome to our laureates today and all guests. This year's prize is about maturity transformation, financial intermediaries, cost of credit intermediation, and delegated monitoring. I have to admit that it actually sounds pretty boring. But don't let these words deceive you. This is really about things that matter to all of us. We all rely on banks, but why are they so fragile? A fragility that sometimes leads to bank runs that can cause them to go under. Why can such events spread like wildfire, causing global financial crisis? The Depression in the 30s was an example of such a series of events. Can this happen again? And how can we reduce the risk of it happening? Are the billions of dollars that we use to save banks during financial crisis really worth its costs? And given all the problems that banks cause, wouldn't it be better just to do without them? The three laureates this year in economic sciences share the prize. Together, they have laid the foundation for the research that has provided credible answers to the questions that I just posed. To do this, we need, or they needed, both theory and empirics. Thus, Bernanke's empirical analysis of the Great Depression and the theoretical contributions by Douglas Diamond and Philip Dybvig about what services banks actually do to society and why this makes them vulnerable and in need of regulation is really an integral part of this year's shared prize. Today, I think we can say with confidence that society is much better at counteracting the mechanisms that led to the Great Depression. Providing the theoretical and empirical foundations for this is a great achievement to the benefit of mankind. So thus, I'm very proud and honored to present this year's laureates. And we're going to start with Ben Bernanke, born in Augusta, Georgia. He has a PhD from MIT and now holds a position at the Brookings Institution in Washington. Please, Ben.
Okay, well, thanks very much to the Nobel Prize Committee and to all the organizations that have made this week possible. And thanks to all of you for coming to listen to these lectures. You see the title of my lecture, Banking, Credit, and Economic Fluctuations. Here's kind of an overview of what I'm going to talk about. Now, my basic argument, it runs through a lot of my research, is that banking and credit markets can become stressed, and I will explain very precisely what I mean by stressed, which leads to increased cost of borrowing and reduced availability of credit. Now, the important thing is that this credit market stress can have very consequential effects on the macroeconomy. And I'll do two case studies today. One of them is the Great Depression of the 1930s, and the second is the global financial crisis of 2007 to 2009. But if I have time, I'll talk a little bit about how these ideas have gotten into standard macroeconomics about ordinary business cycles and ordinary monetary policy. So it has been something that has affected standard non-crisis analysis as well as episodes like the global financial crisis. Now, in order to talk about what it means for have a credit market be stressed, we have to talk about the economics of lending. Now, lending markets are different from, say, markets for apples because they involve imperfect information and asymmetric information, meaning that one party to the transaction knows more than the other about the product being sold. In this case, borrowers tend to know more than lenders about their own financial capacity, their own plans, their risks, what they're going to do with the money. Can you imagine if this market was one in which, for example, banks offered 5% loans for small businesses and just anyone who wanted to come to the door could take it? Well, would that work? Obviously not. You would have people who knew themselves to be very risky to come and take loans, and that's called adverse selection. Or you would have people come and take the loans and use them to make parties or to do anything that other than what they're supposed to do, and that's called moral hazard if you don't have some kind of oversight. So you do need banks or something like banks, because what banks do is they overcome these information problems by screening borrowers. You have to fill in lots of forms, by monitoring them, by putting restrictions on what they can do with the money, and requiring collateral. So banks, the purpose of banks is to overcome the information problems that permeate lending markets. Now, there's a cost to all this. So the cost of making a loan, again, includes all the costs that the bank incurs in screening, monitoring the potential borrowers. A concept I'll be using throughout the lecture is the external finance premium, or the EFP. That's basically the entire cost of making the loan over and above the interest, the pure safe rate of interest that's in the economy. Okay, so think of it as being what the bank has to be paid in order to make loans instead of holding safe securities. Now, the EFP, the external finance premium, is borne by the borrower because the lender can always go to the safe treasury market. So different borrowers have different EFPs. But as you'll see, even though, say, a small business has a higher external finance premium, has to pay more to get a loan than a big business, the EFPs tend to go together when the economy is getting stronger or weaker. And that will be an important concept as we look at the effects on the macroeconomy. Now, it's important to recognize also that we talk about borrowers, mortgage borrowers, small business borrowers, but banks themselves are also borrowers. They have to get the funds they need to lend to ultimate borrowers. And for reasons that will be discussed by my co-laureates, Diamond and Dybvig, they tend to borrow on a short-term basis, deposits or other types of short-term money, which is valuable to the customers because of it's easily converted to cash when it's needed, and it provides a transactions medium in order to buy and sell. So banks tend to rely largely on short-term funding, but that makes them vulnerable to runs. George Bailey, It's a Wonderful Life, his savings and loan came under pressure because people lost confidence in his savings and loan and pulled out their money and forced it to fail. Now, panics are a real concern. When there's a lot of panics or runs going on, banks become very cautious. They stop lending to risky borrowers because they want to maintain confidence. And this is called the flight to quality. Instead, they invest in very safe securities like treasury bills. The problem with that is that if banks stop making loans to the private sector, all of this skill they developed, the accumulated information, the relationships, and so on, the loan officers, the accountants who have developed the information needed to make loans, all of that is essentially being wasted because they're not making loans to the private sector. Now, an important insight here is that for both borrowers and lenders, the external finance premium depends a lot on how wealthy, how well off both sides of the transaction are. When borrowers have high net worth, they are essentially partners with the bank in their investment. The borrower has to bear more of any losses that occur, creates a financial cushion for the bank, and it gives the appropriate incentives to the borrower, because if they are the owner of a very large fraction of their home or their small business, then their efforts to make the business more successful will give them additional profits, as well as the bank, which owns essentially some half or some other fraction. Likewise, when lenders are well off, when banks have lots of capital or cash to absorb losses, then their funders will be much more confident that the bank is not going to fail, and therefore the bank will not have to worry so much about runs or panics. So again, the external finance premium depends on the net worth of both borrowers and lenders. It also relates to the state of the economy. First, if the external finance premium is very high, that is, it's very costly to make loans to the private sector, that's what I mean by a stressed credit market, a high external finance premium. When that's true, then credit standards become tight, lending becomes scarce, credit is not available, and that obviously is going to slow the economy down. In the other direction, if the economy is weak for whatever reason, maybe an oil price shock or something else, that hits the net worth, the financial health of both lenders and borrowers and makes it more difficult to make loans. And so that there's by very relationship, external finance premium is affected by the economy affects the external finance premium. Now here is an attempt to measure the external finance premium. This happens to be from a paper by Simon Gilchrist and Egon Zakrasek. They look basically at the difference between the return on corporate bonds, carefully measured, and treasury securities, safe treasury securities of the same maturity. And they show this series going back to the 1970s. So a higher, this is a proxy for the external finance premium. When that value is high, that shows that the credit markets are under tremendous stress. The gray bars refer to periods of recession. And what you can see, a couple of things. One is that the external finance premium does tend to go up during recessions, generally. Secondly, that the external finance premium has become more volatile over time, in part because borrowers have become more dispersed. We have more low-rated borrowers as well as the highest blue-chip borrowers. But notice how the external finance premium responds to crises. After 2000, in the recession that followed the dot-com bust, you see external finance premium rising. And then after the recession, it rose as Enron and WorldCom and other companies came under pressure because of the fraudulent activities they were doing. Now, if you want to see a really high external finance premium, take a look at the global financial crisis in 2007 and 2009. This was saying basically if credit markets were shutting down completely during this period. And then another place, if you look at the last very short recession that began the pandemic, you see a sharp spike around March 2020, which was another financial crisis that the Fed put out pretty quickly. So let me do a little case study here, which is the Great Depression. Now, over the last 25 years, a lot of work has suggested that the Great Depression of the 1930s, which of course was a very consequential event, was caused in significant part by a malfunctioning gold standard. Before World War I, most countries tied their currencies to gold, and that kept exchange rates fixed and promoted trade, etc. The gold standard was suspended during the war, and after the war, they tried to reconstruct the gold standard system. But for various reasons, which would take me too far afield, there were structural flaws in the new gold standard. And moreover, because there was a lot of residual hostility between France and Germany, for example, after the war, countries didn't work together to make the gold standard work. And so the gold standard collapsed in the late 20s and early 30s. It brought down the money supplies around the world, and that in turn brought down prices. So we're having inflation today. Well, in the 1930s, they had deflation. Prices were falling. And some evidence that the gold standard was important, and I've worked on this myself. I've been very interested in the Depression for a long time. But very simple evidence is that countries that, for whatever reason, left the gold standard relatively earlier, like Great Britain, Japan, and the Scandinavian countries, recovered from the Depression much more quickly than those that stayed on the gold standard late into the 1930s, like France and Switzerland. So that's, again, that's become a very central idea in the explanation of the Depression, but there's still problems and questions to be answered. What was the mechanism? Why did deflations lead to big declines in output? Why was the recovery so slow in the United States and other countries? Well, I would argue that the credit market stress, along with the gold standard, was a very important cause of the Depression. There was certainly a lot of credit market stress in the 1930s. In the United States, we had something at that time of something like 25,000 banks. We had very, very large numbers of very small banks, a few large ones. About 40% of those banks disappeared between 1929 and 1933. By disappeared, they failed, closed, or were absorbed by other banks. So, and that happened because there was massive runs, bank runs, where people lost confidence in the banks and pulled out their money, and that made banks, of course, the ones that were closed couldn't make loans, obviously, and the ones that survived became extremely cautious, being very reluctant to make loans to the economy. Likewise, on the debtor side, there was massive insolvency and delinquency. Let me point to these first two bullets here. The first one is a survey in 1933 looking at 22 cities showed mortgage delinquency rates ranging from 21% to 62% of homeowners were behind on their payments. Secondly, about half of all of our mortgage debt was delinquent in 1933. So this is far worse than what we saw after the global financial crisis. Private borrowers were in very bad shape and unable to make payments on their loans. And surveys of banks showed that what they were trying to do was not to make loans, but rather to liquidate the existing loans, call them in, and to refuse to make any new loans except to the very, very safest borrowers, of which there weren't that many. So between what was happening to the banks, the runs, and what was happening to borrowers, the credit market was basically shutting down. Now, this helps explain a lot of interesting facts about the Depression. I won't go through all of these, but let me talk about the last four quickly. First, in the United States, there was a 30% decline in prices between 1931 and 33. Why was that so damaging? Well, one of the reasons was the effects on borrowers. Suppose you're a farmer, you owe a certain amount every month on your mortgage, and the prices of the things you grow, your commodity prices, are falling by 30, 40, 50, 60%. How are you going to make your payments? You're going to go into default. So the decline in prices had its effects on the economy by putting many, many borrowers into very bad situations. A strong recovery began in 1933 when Franklin Roosevelt became president. In my opinion, Roosevelt did exactly two things that made the economy better. All the programs, all the Works Project Administration, all that stuff was small potatoes. What was important was first, that he weakened or eliminated the relationship of the dollar to gold, got off the gold standard. That was very important. But the other thing he did was he stabilized the banking system. Shortly after he became president, he called, quote, a bank holiday, and all the banks had to shut down. And he promised the American public that they wouldn't open up until the government had inspected them and was confident that they were in viable condition. And then the Congress passed deposit insurance, so that small depositors would be guaranteed that even if their bank failed, the government would pay them off. And that led instantaneously to a stabilization of the banking system. And that, of course, as the banking system became workable, that led to lead to recovery. Now, the recovery also, even after the going off the gold in 1933, the recovery was very slow. When the United States entered World War II in late 1941, the unemployment rate was still 15%. In the United States, very high. So it was a very slow recovery. Why? Well, I would argue that on the one hand, banks, although they were no longer failing, they were still very, very cautious. And borrowers were still in very, very bad financial shape. It took a long time for them to work out their debt problems. And for that reason, credit was constricted, and that kept the economy from recovering more quickly. And finally, just some other work that I did with a historian at Princeton named Harold James. We looked at 24 different countries and compared them how serious their banking crises were. And we found evidence that all else equal, that countries where the banking system remained stable, and that included Sweden, Japan, the Netherlands, that they did better than countries where there were severe banking crises like Germany, Austria, and the United States. So clearly that across countries there was some evidence that the collapse of the banking system was a cause of the Depression. Second case study, the Great Recession of 2007-2009. I argued that the Depression was the product of really two main forces, the gold standard and the financial crisis or the breakdown of credit markets. I'm going to argue that the breakdown of credit markets was basically the main reason for the 2007-2009 recession and for the very slow recovery that followed. Now, there were changes in the financial system between 1929 and 2007. In the United States, many financial institutions that were not officially banks grew up. Mortgage companies, consumer finance companies, investment banks, money market mutual funds, securitizations, off-balance sheet vehicles. I could go on for a while. All these companies or vehicles were created that did lending or held credit instruments, but they were not banks. And the fact that they were not banks meant that they were not eligible for deposit insurance. But nevertheless, they still financed themselves by using short-term funding, which meant that they were vulnerable to runs, potentially. Now, everybody knows about the subprime mortgages and how disastrous they were, but why were they so disastrous? One of the things that confused us at the Federal Reserve was that subprime mortgages were not a large asset class. One of our staff calculated that if all the subprime mortgages in the world went to zero in one day, it would be like a bad day in the stock market. It would be almost nothing. The reason the subprime mortgages were so damaging was because they were sprinkled essentially throughout the financial system. They were held in the portfolios of banks and shadow banks. There were many derivative instruments that were tied to subprime mortgages. There were securitizations that included subprime mortgages, and on and on and on. And what happened was that the investors, particularly in shadow banks, but also in commercial chartered banks, became very fearful that their particular institution was very exposed to subprime and other bad mortgages. And so there was an ongoing run, maybe a slow run in some cases, on these types of institutions, which in turn led them to dump their assets on the market because they didn't have the cash to make those loans, which led to what's called fire sales. So emergency sales of credit really knocked down the price of credit instruments, raised interest rates on credit, and brought not just the shadow banks, but even many major commercial banks in Europe, of course, as well as in the United States, close to the brink of insolvency. Now, borrowers did come under great stress in the global financial crisis. In the United States, there was a housing bubble. When the housing bubble burst, then many mortgages holders or homeowners were, quote, underwater. That is, their mortgage value was bigger than the price of their house. And so in the United States, when that happens, you can go to the bank and say, here's the key, I'm leaving. You know, you don't have to pay off the remaining part, and that happened a lot. Delinquency rates rose sharply, and people stopped spending. Consumer spending dropped. There was also a lot of delinquency among businesses, but even, of course, the small businesses were badly hit because they couldn't get credit, but even very large businesses had difficulty. You may remember that the US government had to rescue General Motors and Chrysler because they were about to fail. So, as in the Depression, the stress of credit markets led to the downturn. I would argue that the very severe recession of 2007-2009 and the slow recovery. Now, there's no particular reason why, on the one hand, the lender's side or the borrower's side should be the most important, but I would argue that in this particular episode, 2007-2009, the global financial crisis, it was the financial panic that put the financial markets and financial institutions on the brink of failure that was the more important factor in terms of why the recession was so bad. Particularly after Lehman Brothers collapsed in September of 2008, there was basically a complete shutdown of our financial lenders, financial institutions, and that had, of course, very, very negative effects on the economy. A bit of evidence here from a paper I wrote in 2018 at the Brookings Institution. The black line shows you the actual path of US GDP, real GDP. The gray bar is the recession, so you can see GDP falling during the recession. There are the blue line, which I call panic indicators. That is essentially the forecast of output that comes when you use variables related to the financial panic, the things that were affecting lenders, like the cost of funds to banks, for example, or the price of credit securitizations. And what you can see, and these are actually very far ahead forecasts, the panic indicators, that is the indicators of stress in the lenders, forecast the GDP extremely well. Whereas what I call the delinquency indicators, which are measures of what rate of the mortgage borrowers were failing to pay, is correlated with the actual GDP, but is much weaker. So I'm not saying this is a general result, but in this particular episode, it was the crisis on Wall Street that was more important than the stress, as dangerous and as damaging as it was, on consumers and homeowners. So what are the implications of that? Well, one of them is that if the financial system is collapsing, in the 1930s, until Roosevelt, they didn't do anything about it. So, it went on, and it brought the credit markets down. One of the lessons I think we learned from the Depression is we have to not allow that to happen. And the Federal Reserve and the Treasury worked very hard to stop the financial crisis and to get the financial institutions lending again. Now, that's after the fact. That's after you have the crisis. It's better not to have the crisis in the first place. And how do you do that? Well, I think it's very important to have strong financial regulation that makes sure that the financial institutions are safe and sound, meaning they have very good capital, that they have safe portfolios, that they are not taking excessive risks, and so on. And you should have a macroprudential approach, meaning that you should be looking not just at individual institutions, but thinking about the entire system and how problems in one part of the system can affect other parts. My sense is that globally, since the crisis and the Great Recession, that regulation has been a lot of progress, particularly for commercial banks. In the United States, commercial banks hold a lot more capital than they did. They are more liquid. They do stress testing to make sure that they're not holding overly risky assets. My concern is that the shadow banks, which were the original source of the crisis, there's been some regulatory change, but not nearly enough, in my opinion. And that is, I think, a problem that's still there. And we saw that in March of 2020 when there was a very sharp but short financial crisis, which came primarily from the shadow banks. So I think that's a lesson of this whole experience, and we need to do something about that regulatory area. I'm close to the end here. I don't know how much time I have, but I will talk a little bit about how this research has entered into the mainstream macroeconomics, how it becomes part of ordinary business cycle analysis. And I'll talk about one page each, one slide each on two topics. The first one is that these models of credit stress can help explain why recessions tend to last as long as they do. Even if there's a once and for all shock, a recession will tend to last for a while. And the reason for it is, I would argue, is that when there's a shock to the economy, say again, an energy crisis, that drives down income and wealth, that increases the external finance premium in the economy. That is, it makes it harder. Credit markets become less efficient. Borrowers are more stressed. Banks are becoming more conservative. That reduces the availability of credit, and that amplifies the shock. It makes the economy weaken even longer than the initial shock did. And likewise, in the other direction, if there's a positive shock to the economy, that makes borrowers and lenders better off. That reduces the external finance premium and makes the economy even stronger. So credit factors or stress in credit markets tend to amplify ordinary recessions and ordinary booms, a phenomenon which we have dubbed, my co-authors and I, Mark Gertler and Simon Gilchrist, have dubbed the financial accelerator. Because Mark and Simon and I have created a econometric macro model that incorporates these factors and found that we could better match the data, match the actual behavior of the economy with a model like that. A second thing that we've done that related to ordinary macroeconomics is looking at how monetary policy affects the economy. Monetary policy seems to be quite powerful. And there are periods where it has had very big effects, particularly during tightening episodes. And that's a little puzzling because, for example, studies of big firms' investment show that they're not that responsive to short-term interest rates. So what is it that's making the economy slow down when the Fed raises interest rates or the Riksbank raises interest rates? Well, these theories give us something called the credit channel of monetary policy. And the idea, once again, is that if the Fed raises interest rates and slows the economy, that's going to tend to raise the external finance premium by making borrowers and lenders worse off, by reducing employment, by reducing profits, and so on. And that, in turn, will affect the economy. So that's a channel through which monetary policy can affect the economy. So that's another place where these theories have been, I think, helpful in understanding the ordinary macroeconomy. So I'm come to my conclusion, which is that first, a lot of this might sound very familiar to you by now, but when I was 40 years ago, when I was 29 years old and I wrote the paper that was cited by the Nobel Committee, there was very little attention paid to financial instability as a factor in macroeconomics. George Akerlof, a Nobel winner, wrote a very interesting historical paper arguing that the macro schools of thought, like the Keynesian school of thought, for example, had no place for financial instability as one of the factors affecting the economy. So in particular, and I tell you this from personal experience, when the financial crisis hit in 2008, the Federal Reserve's models consistently underestimated the impact on the economy because they were not prepared to take into account the full effect of stressed credit markets. So obviously, to understand the effects of financial crises on the economy, we have to understand these relationships. And as I've argued, that looking at variations in the effectiveness of credit markets can also help us understand more normal circumstances. Right now the Fed is tightening interest rates. That presumably is making credit markets more stressed. That is one of the reasons why our economy in the United States is slowing down. Now, the last point I want to make is that there is a policy implication of all this, which is that we need to avoid unnecessary deteriorations in credit markets. That involves, first of all, before the crisis happens, it involves monitoring and effective regulation that makes the financial system more resistant to shocks. And I'm a big regulation of the financial system, I think, is very different from regulating other industries. It's a very special industry. It requires a particular type of oversight. I think it's very important to have adequate oversight to make sure that you minimize the risk of major breakdowns. And then on the other side, occasionally, of course, financial crises do happen. There have been financial crises ever since the Romans, so that's a long time ago. So they do happen, and when they happen, we need to have good tools to deal with them. So just to give one example, the Dodd-Frank reforms of 2010 included something called a liquidation authority, which would allow the Fed and the Treasury and the FDIC to, quote unquote, safely wind down a failing financial firm in a way that didn't have so much damaging effect on the rest of the financial system. So having tools ex post to fight the crisis is equally important. So those are some of the implications of the stress and credit markets perspective, and how it can have both major effects like the Depression or the global financial crisis, or more moderate effects in standard business cycles. Thank you.
Thank you. Thank you, Ben. It's amazing to see how important this work that was done 40 years ago has turned out to be. So in the price motivation, we actually pinpoint 3 contributions, 3 papers that are all of them almost 40 years old. And Ben wrote one of them during his time in grad school. And the second laureate that we're going to listen to today is Douglas Diamond. He is author of 2 of the other papers. So Douglas was born in Chicago and wrote this very important work when he was in grad school at Yale, and he is now back as professor at the University of Chicago. Please, Douglas.
Somehow it got out of the right mode there. There we go. Well, thank you very much, John. I want to begin by thanking the Royal Swedish Academy for this great honor, and in addition for recognizing this important area of research where I've spent close to 80% of my career trying to understand. So, my clicker starts to work here. So a little bit about how I got interested in this. It's not the kind of thing you just, as a kid, you start thinking, well, how do banks affect the real economy? So it turns out I got interested in economics when I was in college. I went there originally to be a molecular biologist, but then I found economics a bit easier, so I did economics. And I took an amazing and transformational course in my senior year from Jerome Stein at Brown University. And the entire course was a book, one of the best books written in economics, by Milton Friedman and Anna Schwartz, called A Monetary History of the United States. And there was a very good description and analysis of how monetary policy worked, how exchange rates worked, gold standard and things like that. But the thing that had the biggest impact on me was the discussion of the 1930s in the United States and how there was interaction between monetary policy, lots of bank failures, and in particular lots of bank runs. So that got me interested in thinking about the system, and this clicker is going crazy here. I'm going to use my keyboard instead, lower tech. So my approach to understanding the financial system and the role of financial intermediaries has been, particularly in the 2 papers I'm going to talk about today, to think about what is special about the mechanism or set of contracts that the financial system writes, and how do those contracts or mechanisms affect the real outcomes on the economy. So what good things do these contracts do, and what potential bad things come out of these contracts? And in the modern economy, these things I'm going to call banks and put quotation marks around them. Banks, because it's shorter than financial intermediaries. Banks could be essentially any institution that writes the contracts that I'm going to talk about. You don't have to have a commercial bank charter. You don't have to have your ability to pay bills or write checks on the outcomes. So these could be many other institutions, which I'll talk about in a minute. Ben actually mentioned a couple of the institutions. But for now, just think Lehman Brothers isn't a commercial bank, but Lehman Brothers definitely fits both the models I'm going to talk about. So the first paper from my doctoral dissertation is called Financial Intermediation and Delegated Monitoring. And it asks the question, what's the best way to set up a mechanism, a firm, that monitors borrowers on behalf of other people? So we're going to have business borrowers that need monitoring. We don't want to have everybody in the world monitor, so we're going to get someone to do the monitoring. And the question is, how do we set up contracts to do this? So we're going to think about conflicts of interest in lending. So we're going to think the whole basis of what these intermediaries are doing in this description of the world is that there are certain pre-existing conflicts of interest in lending, which I'll describe. And we can think about what's the best way to resolve these conflicts of interest when we don't use banks. We just write contracts between investors and borrowers. And what's the best way to do it with banks? So there are going to be conflicts of interest between investors and borrowers that are just always present. But we could bring in a third party called a delegated monitor, which will turn out to be a bank. So then we're going to have three conflicts of interest, or three parties who have mutual conflicts of interest: borrowers, lenders, and bankers. So that's the setup. So here's what I call direct finance. This is how you do finance without having any banks involved. There are a bunch of small investors, so we're assuming that it's not like one rich person who does all the lending in the world. So we have a little bit of income distribution here. And you need, say, 10 or 20,000 investors to lend some money, to invest some money into some firms. And that's going to be the end of the story. If these are the only parties to the contracts, how do you make contracts where you overcome the conflicts of interest, which I'll define in a second? The alternative is not doing it the simple way, doing it sort of the indirect way. You stick an intermediary in the center, a bank, a quote-unquote bank, and why and under what circumstances do you do better with contracts that include this middle entity, the financial intermediary? So the small investors invest money or lend money to the bank, and the bank invests money or lends money to the firms or other borrowers who need to borrow money. Okay, so I said there's a conflict of interest. I'd say in finance, there are lots of conflicts of interest, but the most important one is getting the borrower to repay the lender or investor. Because once the money has been passed on to the borrower, they have other maybe better things to do with it than pay the money back. They can invest it in special investments and projects that may or may not be profitable, so you might not have to screen the projects after they make them. They could do more nefarious things, like do a poorly priced deal with their brother-in-law and sort of tunnel money out of the firm, and sort of cooking the books, things like that. So how do we provide incentives to overcome this pre-existing conflict of interest? So I'm going to consider two contracting ways that are very highly stylized versions of stuff we actually do in the world to get a borrower to repay. So the first thing you can do is impose a penalty on the borrower when the borrower doesn't repay. I'm going to call that foreclosure. So I'm going to think of foreclosure on the borrower, taking something away from the borrower as a penalty. I mean, let's say you don't pay your home mortgage. If you don't pay your home mortgage, the lender at least has the right to take the house away from you. So that gives the lender the right to sell the house, but it probably has a bigger penalty effect on you. Suppose it's a house and you have children. The house gets taken away, your children will have to go to another school district, all kinds of stress in your family will occur. So we'll think of that as a penalty. So in the really old days, there were penalties like debtors' prisons. So presumably that there's no great joy for a lender of sending the borrower to debtor's prison, but the fact that you might go to debtor's prison would increase the incentive of the borrower to repay in the first place. So the first technology is this thing, foreclosure. The good news is it makes the borrower pay. The bad news is when you actually impose that foreclosure or penalty, it's tremendously inefficient. You really don't want to be doing that very often. And there are huge upfront costs from writing contracts that use that very often. The second thing you can do is the lender, or lenders, each lender, could continuously monitor what's going on in the business to make sure that these conflicts of interest about doing the wrong investment or cooking the books or lending money to your brother-in-law, to make sure those things don't happen. And once you've made sure those things don't happen, you can get the borrower to repay you without this threat or act of actual foreclosure, without actually throwing them into debtor's prison. So you can monitor, then you don't have to impose this inefficient penalty, but it's costly. It takes, you have to take a lot of time and resources to continuously monitor the borrower. You incur these fairly large costs up front, but the large upfront costs are worth it in saving the inefficient foreclosure. So suppose you weren't going to monitor at all. If you don't monitor at all, it turns out if you have these two penalties, the best thing is to use the first one, the foreclosure or the penalty, And you only impose this penalty for small payments. Obviously, you want big payments. You don't want to punish big payments. So it turns out if you just say, what's the optimal financial contract in the set of all financial contracts, the optimal financial contract here is a debt contract where you specify an amount, says, pay me this amount. You can pay me more if you wish, but you won't. Pay me this amount, and if you pay me this amount, I won't foreclose. Pay me any amount less, I will. That turns out to be, in the setup I have here, the best possible contract. The good news is the borrower will repay whenever the borrower can. So this is like 80 years in debtor's prison. You're going to pay that 500 euros, no question about it. But if you owe 500 euros and you only have 200, off to debtor's prison you go, which is not a great place and not a very efficient thing to do. So this is, again, this is not going to be a problem if the borrower could always repay. If you knew you owed 500 euros, you always had 500 euros, not a problem. But if you only had 200 and you owed 500, it would be a bad situation. So let's imagine there's some uncertainty in how much the borrower can actually repay. Okay, so here's just a super simple example. So you lend some money to a firm, and you lend them some upfront money. Like you lend like 1.1, let's say these are millions of euros, 1.1 million euros, and his or her project, the firm's project, will either produce 2 million euros or it'll produce 1 million euro. And imagine the odds are 50-50, so the probability of each of those is a half. Well, in that case, if you need to get the borrower to pay you back 1.1, which I'm assuming, you're going to have to impose this foreclosure or liquidation half the time, right? Because the borrower can never pay more than 1 when that's all the cash the borrower has. Some of the times the borrower has 2, other times the borrower has only 1. So if you wrote this contract that says, pay me 1.1 or I liquidate, I take your house away from you, you're going to take the house away or liquidate 50% of the time, and that's pretty bad. That would be likely, if it was very inefficient to do that, that would either cause tremendously expensive credit, like Ben was just describing, or it might even be the case that you couldn't possibly raise credit because the lender would get so little half the time they wouldn't be willing to lend to you in the first place. Now, the average value of the cash the borrower actually has, the expected value is 1.5, half of 2 plus half of 1. If the borrower always had 1.5, then debt contracts enforced by foreclosure would work perfectly. Say, pay me 1.1, well, I always have 1.5. So nothing inefficient would actually happen. Threats to inefficient stuff would happen, but actual inefficient stuff would never happen. So again, how do you get the borrower to repay without monitoring? Use debt with foreclosure. But as I just said, if the borrower has to pay more than 1, we have to foreclose inefficiently half the time, and the borrower gets less than 1 in that case. So imagine you got 0 in that case. Well, if you got 0 whenever you could, the half time you couldn't pay, the borrower would get at most 2 half the time and exactly 0 the other half. So if the lender is requiring a 1.1 expected return, in this case, the lender would not be willing to lend to you. So the best contract without monitoring is debt with foreclosure or debt with penalties. It works well if the borrower doesn't have any volatility in how much they can repay you. Works really poorly if there's a lot of volatility or uncertainty. Okay, so that's what we say about unmonitored debt. Suppose you monitor. Well, if you monitor, it maybe costs something up front, but then when the borrower has 2, you can collect up to 2. When the borrower has 1, you can take the entire 1 without this inefficient foreclosure and stuff like that. So if you had somehow monitored, you could do way better. You could write a much better, much more efficient contract than the one I just described. Okay, so that's the good news. If you just monitor, you can save all of these inefficient foreclosure costs. So monitoring, which could be find out what the actual cash flow is and renegotiate bond covenants, making sure they're not stealing the money, making sure the brother-in-law is not doing contracts, all of those things, it avoids the need for these inefficient penalties. Now, I mentioned that there were many small investors here, so we had 10,000 investors in this case. And those things that look like magnifying glasses, those are people monitoring. So if each of the 10,000 investors went there and monitored again and again and again, imagine each investor made a $100 loan and it cost $100 to monitor. That'd be a pretty stupid thing to do, to spend $100 to monitor a $100 loan. So if you have to incur the cost of monitoring 10,000 times over, undelegated monitoring, direct finance with monitoring is going to be too expensive. So if you borrow directly, if you have this direct finance, you borrow from lots of people who don't have, €1 million each, you're going to find the best possible contract is going to be a an unmonitored debt contract, an unmonitored contract. So if you borrow from directly and there's enough uncertainty about how much you can repay, then you're going to end up finding yourself unable to borrow because the best contract borrowing directly is unmonitored debt, and unmonitored debt doesn't work, and monitored debt is too expensive if you have everybody do it. So then we get, this is the idea about financial intermediation. Instead of having all 10,000 investors monitor, we delegate the monitoring to one party called a banker, and so that intermediary will turn out to be a bank. And we'll see what the optimal contract is to give incentives for this delegated monitoring. It turns out to be something that looks like a lot of bank. So the bank will monitor, the firm will know, and the bank will know exactly what the cash flows are. So the monitoring gets the borrower to repay the bank. The question is, how do we get the bank to repay the investors? So the investors don't see what is monitored by the bank. The bank can see whether or not you're doing a deal with your brother-in-law, but that doesn't tell on the outsiders what you're dealing a deal with the brother-in-law. So you could imagine the bank, the brother-in-law, and you could get together if you're the borrower and say, well, yeah, let's just tell them there was only one this period. We're not going to pay them more than that. Okay, so but what will the investors know? They'll know how much the bank actually repays them. Just like before, the borrower would repay the investors or lenders, and if the borrower paid too little, there'd be foreclosure. Do the same thing here. If the bank pays too little, just have the foreclose on the bank failure, the threat of bank failure turns out to provide great incentives for the bank to monitor and to pay. So investors will know how much will be repaid. They can use a bank debt contract. What's the best way to provide incentives for delegated monitoring? Have the bank use a debt contract promising to pay investors. Have the bank fail if they default on it, pay too little. And this will provide incentives for the bank to monitor and to pay investors. If the bank doesn't monitor, the bank won't have enough to pay and avoid the default. If the bank doesn't pay investors, there will be a default. So, but it turns out for this to work, this is the first key implication of this setup. For this to work, the bank has to be a big bank, has to be large, and it must be diversified. Like if the bank only made one loan, half the time its borrower would only be able to pay one, and that bank would fail with the same probability that the borrower would. So we say the banks have to, for this to work, the bank uses these debt contracts, but the bank has to be diversified. What's the diversification doing? Let me take it to the extreme limit, and you can see it here. In my paper and in practice, it doesn't work this well. So I'm going to talk about something called perfect diversification. So suppose the bank makes lots and lots and lots of loans. It's going to turn out that half of them, and let's assume that it's going to for sure turn out that half of them will be borrowers that have two, and the other half will have borrowers that have one. So the expected amount of cash that the bank could collect from the loans is always up to 1.5. Because there's no uncertainty about what the average borrower is going to pay. We just don't know which borrower is going to be the ones that have two, which borrowers that have one. And then we just write a debt contract with the bank. Let's say it has promised payment of 1.1 per borrower. The bank can collect up to 1.5 per borrower, so then the bank never fails. So in the best case, this diversification says, look, we know we have this foreclosure technology, this punishment technology, debtor's prison, just put it on the bank, but because the bank is so much more diversified, it doesn't actually have to ever default, so the bank could issue perfectly safe deposits. If it ever did default, the bad stuff would happen, but it never needs to default because this diversification. And we diversified not to make the asset of the bank safe, we diversified to get rid of the bank's private information, diversified away the bank's private information about how much the average amount it could collect from all of its borrowers. Now, in the real world, and in my paper, we have banks with imperfect diversification. So even if you make lots and lots and lots of loans, stuff happens. So banks are going to fail sometimes. So banks are going to fail if they're small, as they were in the US or in my home state of Illinois until actually quite recently, small, or they're less diversified. They just had one industry or something like that. Or they're a very, very large bank, but they're extremely exposed to macroeconomy-wide risks. So it's important for bank supervisors and regulators to not look at whether their credit standards are good or not. That's an important thing to make sure that they're competent. But you have to look at what's the exposure to the macro risks, like national income, interest rates, wars, that kind of thing. And there's always been a focus on this in supervision and regulation around the world, but post the financial crisis, these things called stress tests explicitly look at how exposed is this particular financial institution to these particular large macro shocks that might bring the whole system down. So that's exactly what this says, is that substantial diversification within a large bank without too much excessive exposure to macro shocks is essential for banking to work well. So a more modern name for this stuff is pooling and tranching. Pooling is just a modern name for diversification. Put loans together in a pool, make a bunch of them. Tranching issues senior claims and junior claims. Senior to the outside, some of the juniors retained on the inside is like a bonus. So it turns out this structure resolves tons of conflicts of interest, more general than delegated monitoring. Peter DiMarzo has a very nice paper on this. Now obviously pooling and tranching, the diversification part of it, the pooling part, doesn't work perfectly, we saw that, and it particularly screws up when the correlation is increased among the losses in the assets. We saw this in the housing crisis of 2007 to 9. So when house prices went down worldwide and in the US in particular, all of a sudden the correlation between mortgage defaults, subprime and other ones, went up. The diversification went away, and we saw mortgage-backed securities become unexpectedly much riskier. Okay, so that's the first paper, the first technology. Second one is a paper with Phil Dybvig, bank runs, deposit insurance, and liquidity. So there's me and Phil back about 6 months ago. Or no, that was from 1981. We were standing in Grand Teton National Park, and we were happy because we just thought some interesting thoughts about the world. I don't know, maybe something to do with banks, maybe something to do with something else. The very pretty mountains behind us. So once again, this is an idea of how to explain why banks and intermediaries are good to have in the middle and why they use certain financial contracts. So the financial contract we have in mind here is short-term debt. Why do banks use so much, or banks, quote unquote, financial intermediaries, use so much short-term debt to finance long-term illiquid assets, which in turn turns out to leave them subject to bank runs? So why do you choose to write contracts that leave you subject to runs if runs are so bad? Again, so it's a contract structure, mechanism, design approach to thinking about banks. It has nothing to do with banks being money or regulated or part of needing a charter. Okay, so if you hold assets through a bank, you get a better set of things you can get than if you held the bank's assets yourself. So the point of Diamond Dybvig 83 is that we're going to assume that the bank's assets are long-term, safe if you hold them to maturity, but illiquid. Okay. At one point, we thought about explaining why they're illiquid. We realized, one, that would complicate things, and two, most of the reasons that things are illiquid make our phenomena quite relevant. So we have safe but illiquid. I'll tell you what illiquid is in a minute. Assets, and we show why the liabilities, the deposits of this bank should be short-term debt and liquid. Okay? So basically we're taking solvency off the table as a reason for bank failures. That's not because it's off the table in practice. We're going to say, look, these banks, if you just hold the assets to maturity, everybody knows they're solvent if you wait long enough. So insolvency is not the reason. We're still going to have bank failures. It's going to be caused by potential runs on the banks, and we'll look at what causes these runs in a second. So we're going to assume that we'll show our definition of what it means to create liquidity. So bank deposits are more liquid than the loans they hold. What that means is that if you hold a bank deposit, you get a higher return for, say, holding it for one period and then getting rid of it quickly, versus holding the underlying bank loan yourself for one period and getting rid of it quickly. So you're buying some insurance against getting out fast. And then that's the first part of our model, that we're going to show that banks could do that. And second thing, we'll show that banks should do that, because investors like liquid assets better than illiquid assets because they don't know how many periods they're going to want to hold them. They might hold them for one period, they might not need to they might not need it in one period, then they'd hold them for 2 periods. So there's this little bit of risk left, even though these assets are safe if you hold them to maturity. As an individual, you face this risk. You might need to get out early. If you're what we'll call an early investor, you might need your money in 1 period, where maybe you won't. So liquidity is a form of insurance against this early need for funds. So we're going to think, it's not just about paying your bills and thinking like just liquidity is a form of insurance. So here's a super simple example of our model. Here's the illiquid but safe asset that the bank could invest in. Here's one. If this bank or anybody, you could hold it, the bank could hold it. If anybody invests €1 or 1 unit at date 0, they can either hold it for 2 periods and get 2 out. They hold to maturity. They double their money in that case. Or they can get out in 1 period. They only get 1. So 1 is would be way below the present value of 2. So let's not worry about present valuing stuff. If you say, if you hold this asset to maturity, you double your money. If you get out of it early, you destroy half of that value. That's what we mean by it's illiquid. There's a big loss if you get out in a hurry at day 1. And then the bank is going to issue more liquid short-term claims on this. The bank is going to offer you, if you put 1 in at date 0, you get 1.28 at date 1 or 1.81 at date 2. It's your choice. The key thing here, you see in blue, is that if you held the bank asset directly, you'd only get 1 at date 1. If you held the bank deposit, you get 1.28 at date 1. The only thing that's important in this is that 1.28 is a number bigger than 1. All these things I'm about to say are true for any number bigger than 1. So this is sort of, I'll tell you how the bank creates this asset. This is sort of creating liquidity because you're giving people a bigger return over the short horizon period. You have to it's not free, you have to give up something over the long horizon, but it is a form of insurance against the need for liquidity. So just to see how this model works without too many details, suppose there are 100 investors in the world, and we know for sure that 25 of them will need their money early, call them early investors on date 1. The remaining 75 will need their money late, called their late investors. So we know it's 25 and 75, but we don't know, and no one knows yet, who's going to need it early and who's going to need it late. So there's uncertainty about when you're going to need your funding, so you'd like to buy insurance against this uncertainty, insurance against needing your money early. That's exactly what the deposits do in this setup. And I gave you those numbers before. I didn't tell you whether they came out from. Here's where they came from. This is the case where we say, suppose there's not going to be a bank run. Okay, so if there's not a bank run, let's imagine that means the only people who pull their money out of the bank at date 1 are the 25 people who are early and actually need their money. So if 25 people pull their money out at date 1, we give 25 people 1.28, we have to liquidate 32 assets. You can do the math on your own. And that's going to leave just enough assets, or actually a few extra assets, because I did some rounding here, to pay the people who leave their money in until date 2, 1.81. So what I just showed is if everybody is clear there's not going to be a run on this bank, the bank can actually create more liquid deposits out of less liquid assets. We can actually create liquidity here. That turns out to be a good thing. So everybody would be, oh, okay, if this is the set of outcomes that we're going to get, if there's going to be no run, everybody would indeed put their money into the bank at date 1. Get these returns, and only the proper people would take their money out at day 1. The trouble is, if the bank creates liquidity, which is to say it pays more than 1 to the people who take their money out at the early date, at day 1, there's a self-fulfilling prophecy, absolutely for sure, that the bank is going to fail. If people prophesize that prophecy is self-fulfilling. Because look, how does the bank pay the people who take out at date 1 more than 1? They have to liquidate a bigger fraction of the assets than the people withdrawing. So if 25% of the people withdraw, you liquidate 32% of the assets. Well, if 100% of the people withdraw at day 1, you can't liquidate 128% of the assets because you only have 100% to start with. So you can't give 100 borrowers 1.28. You can't even give 79 borrowers 1.28. So if everybody thinks everybody's going to come and ask for their money at day 1, that'll be a bank run, then everybody who predicts that will rush to get their money out of the bank, because if you leave your money in the bank, you're going to get 0 at date 2. Because, okay, oops, it's going crazy here again, but not that crazy. Afraid to touch anything. So if you get there quickly enough at date 1, you'll get 1.28, but if everybody else is going to take their money out at date 1, there'll be nothing left at date 2. So if these are the payoffs, and whether you're early or late, you want to get your money out at date 1. So if a run is expected, the bank will fail. If the bank will fail, that'll cause a run. This is a self-fulfilling prophecy, a Nash equilibrium. So short-term debt runs can bring down a solvent financial intermediary. If you expect a run, you'll want to get out early. And if you think there won't be a run, then you don't want to get out early. So these multiple self-fulfilling prophecies are one way of thinking about why the financial system is sort of by its very nature somewhat unstable. And you would say, okay, let's just get rid of bank runs by making sure the banks don't create any liquidity. Well, that would stop the runs, but it would stop all of the value added of this liquidity creation. So this view of what the financial system is doing in creating liquidity says these problems are sort of hard to fix because you don't want to, quote, throw out the baby with the bathwater, but there are only a few ways of trying to get the best of liquidity creation without having the runs. So one point I like to make whenever I talk in front of non-academics, and for like the last 25 years, except for the word private on there, which I'll tell you why I put it on, private financial crises are everywhere and always due to the problems of short-term debt. So Ben actually just mentions short-term debt runs are what bring down these panic, self-fulfilling prophecy failures. The private sector can cause problems this way. The government has lots of ways to cause problems. So the public financial crises can come from all kinds of things with fiscal policy and things like that. So, and then bank runs are not just about banks. In fact, banks are just one example of the many type of short-term debt financial institutions. Money market mutual funds in both 2008 and in March 2020. Lehman Brothers, we saw that. Stable coins, Terra and Luna. Short-term securitizations called asset-backed commercial paper. All of these things where they're borrowing short and lending long had in multiple financial crises, East Asia financial crisis, lots of things like that. So borrow short, lend long, and illiquid, that's the thing. It's not just about fractional reserves in the banking system. We already sort of understood if the bank has to give you currency when you take your money, and there's not enough currency in the vault for everybody to take their money out, that's the story of George Baker and It's a Wonderful Life. Your money is in Joe's house, it's not back in the vault. Okay, that's true. That will cause bank runs. Everybody says that one of their currency is not enough currency, the bank's going to fail. You don't need to have to take currency. It's not just about banks. It's about short-term debt. So how could you stop bank runs? If you have a very solvent government, because we know in the past we've had some issues of governments being concerned about insolvency. If a very solvent government, the government can provide deposit insurance. That'll stop this feedback between how many people you think are going to withdraw and whether the bank has to liquidate too many assets. We can do lender of last resort as long as you actually do it. The Federal Reserve didn't do it in the 1930s, as it turns out. So no solution is perfect because, actually, as Ben mentioned, this run risk migrates out of the regulated sector. So two optimal contracts in the financial system: pooling and tranching, diversification and issuing senior claims to resolve conflicts of interest, creating liquidity by borrowing short and lending long. These are, I would say, and this is sort of in retrospect, I'm starting this talk, probably 80%, 90% of what the financial system has done in creating new products, and for good or for evil, has been some combination of these two technologies. So this is sort of maybe the financial technology that most stuff has. And you have to understand a new product. You should say, okay, how does it mix these two? Does it use too much of one or the other, or too much of both? And if you see a financial crisis, you got to see if it's a fear of fear itself crisis or not. So the second and regrettably only other paper Phil Dybvig and I wrote in 1986 discusses some implications of this for regulation. If Phil has time, I hope he talks about it. Since then, I won't have time to talk about any of the details of this. Since then, Raghu Rajan, who's up there and back there somewhere, have done some work that links again this short-term debt to financial crises in a way that is consistent with the two things I just said, but introduces all kinds of interesting new channels. So again, financial intermediation is to help resolve conflicts of interest in the world. We add one new idea that turns out to be pretty powerful. Short-term debt is a stronger commitment to pay than long-term debt, especially for financial intermediaries, especially for banks. It's harder to work out outside of bankruptcy than long-term debt. And turns out that adds all kinds of interesting facts and complications. So Raghu, thank you, the very long-term relationship of co-authoring. Here are my remaining co-authors. There's Raghu, there's Yunjahu, who has been on the last 4 years or so, has been writing papers with Raghu and me, and he's part of the long-term team, I hope. Anil Kashyap, Jigwahe, my colleagues at Chicago Booth I've written with recently, and Rover Recchi, who used to be my colleague at Chicago Booth, who I wrote sort of helped me learn how to write papers, wrote my first several papers, and those were more about private information and in asset markets. Last set of thank yous I have to make are to my thesis advisors when I was in graduate school at Yale. Steve Ross, who was my mentor and basically taught me how to do economics. I think I'd probably still be trying to finish my thesis were it not for Steve. And then my advisors through the whole period, but Steve actually showed up in my third year in graduate school. So I was already working on banking and things like that before I met Steve. And some of that a lot of that had to do with these two advisors, Martin Shubik and James Tobin, who made clear to me in various ways that the financial system was not integrated into the rest of economics in an acceptable way at all. James Tobin, for the macroeconomics, really didn't consider financial markets in proper ways. There's something called the interest rate. There was lots more going on than that. And then Martin Shubik pointed out that the microeconomics of money and banking was like understudied and poorly understood. And the general equilibrium theory, the main thing we would use in most of economics, had no role for any of these. And you could ask it all kinds of questions and it would give you the totally wrong answer. I want to thank my co-authors. I want to thank my advisors. And I want to thank you very much for listening.
Thank you very much, Douglas. It was a cool picture that you showed of two cool guys from grad school 6 months ago, I think you said. And when I saw the picture, it reminded me about, I think, another shared interest that you have with Philip Dybvig, music. So Douglas was, maybe is still a disc jockey, focusing in German metal, I think. And also Philip is very much interested in music. And you told me the other day that it was close that actually you had focused on music, becoming a musician instead. So we are very glad that you chose economics, and we are also very glad that Philip Dybvig, that you are here with us today. So take it away, Philip.
So thank you so much, John, and the prize committee and everybody else involved with this amazing week in Stockholm. I want to talk about the second paper Doug talked about, because that's seems like it's the second paper Doug mentioned is my joint paper with Doug that was mentioned in the prize description. And I want to focus on multiple equilibria, which is one feature of the model. And it was a theme in my research before this paper. And I want to give a call out to my co-authors on the prior research and talk about it. Having multiple equilibria, Doug mentioned that. There's an equilibrium with bank runs, and in our model, and there's an equilibrium without bank runs. And there were actually sprinkled through the literature some descriptions of multiple equilibria. But I think at that time, multiple equilibria was largely viewed as a defect in models. That we had a statement in the introductory macro course that says, basically, they wanted you to have enough equations to determine the equilibrium. It says if you don't have an equilibrium model, it's not a real. If you don't have a unique equilibrium, it's not a real economic model because you can't do prediction. And like a lot of important sounding things, this doesn't bear looking into. But when you're a first-year graduate student and you need something to hold on to, a lot of people will just take what you're given. People had looked at multiple equilibrium, people in game theory especially, had looked at things like coordination games where you'd have multiple equilibria. In the Walrasian model, we know that in general, there are lots of competitive equilibria. But I think, again, these were viewed largely as defects. And in our paper, I think it helped people to understand that having multiple equilibria can be the main point. It can be something that's important part of the economics that we should be concerned about. I have no conflicts to report. I actually like it when the medical school people put this up here because it's important. And I've seen papers by people who had big conflicts that they should have reported, and they didn't. So I'm getting in the habit of doing this. Doug mentioned our advisor, Steve Ross. I mean, he's just the best advisor in the world. I can't even imagine life without him. Okay, so this is a brief outline of what I'm going to talk about. So I'm going to talk about what is equilibrium, and the prize paper with Doug, which he's already covered well, so it'll be a review. And prior papers with Chester Spat and Jerry James. I want to talk about the sunspot model of Dave Cass and Carl Schell. Sunspots is supposed to be an exogenous shock that's observable by everybody, but it is not economically relevant. Well, we know sunspots can disrupt communications and in principle, in extreme cases, could bring down the power grid, but that's not the idea. The idea is it's supposed to be something that's commonly observable, but gives us a source of uncertainty that we can use to coordinate on. And then I want to talk about a couple of ideas for where we could go next in the research. Okay, what is equilibrium? So I think the intuition about equilibrium in economics comes from physics. And physics, if you have a ball on a surface, you're going to have an equilibrium where it's a local minimum, or at least flat. If it's a local minimum, then it's going to be a stable equilibrium. You move a little away, it's going to move back. If it's flat, but you have a hill like this, then you move a little bit away, it's just going to keep going away. That's an equilibrium, but you've got to sit right exactly there, and that would be an unstable equilibrium. So a lot of things early in economics, I think, were imitating things that we knew in physics and trying to use those ideas. Two popular types of equilibria that we still use as a definition now are competitive equilibrium and Nash equilibrium. There are many other definitions of equilibrium we use in economics that are appropriate in different situations. But these are the two I want to focus on, and they're very classical. Competitive equilibrium is for a world where agents intuitively are very small. They take prices as given. They look at the prices in the economy and they ask, how much do I want to demand at that price? And an equilibrium is a point at which supply equals demand, or you could say excess demand of each of the agents adds up to zero. So that's a very common notion of equilibrium in economics. Another notion, and that's what's going to be the focus here, Doug mentioned the word Nash equilibrium, which was named after the great mathematician John Nash, who also won the economics prize, is a choice for each agent that's optimal given the choices of other agents. So when we model a single agent, we write down an optimization problem. We say, what is the objective function? The objective function could be to maximize profit, or the net value of profits over time, or it could be to maximize utility. Utility is a way of representing preferences. So we assume in economics often assume that agents act as if they're maximizing this utility function. And we write down that utility function. That's for a single agent. You just write down an optimization problem. But what do you do when there are multiple agents and they're interacting? And the way that we describe that is through some notion of equilibrium. Because we have to say, well, what's optimal for me is going to depend on what the other agents do, and what am I going to assume about that? And in Nash equilibrium, the assumption is simple. It's that that everybody is making choices that are consistent in the sense that what I assume that they're doing is what they're going to want to do if they assume the same thing about what other people are doing, and they're assuming that I'm doing what I'm going to choose optimally. So that's a notion of Nash equilibria. And when we say that there are multiple equilibria, it's just saying that there's more than one vector of prices or one vector of choices that is an equilibrium. So Doug already talked about our model. In our model, you can have an equilibrium where everybody takes their money out, whether or not they need it. We call that a run. Turns out not to be very good for anybody. And if you think everybody else is going to take out their money, then you realize that the bank is going to run out of money before you get there if you wait. So you're going to take out all your money if you can as well. And alternatively, there's an equilibrium where everybody takes out their money only if they really need it. So it could be that somebody down the street is selling a classic car, which I think is super cool, and I really want my money out now, and I'm going to take my money out to do this. Or it could be that I have some kind of health issue. It could be I have a friend who needs money. It could be that I feel a sudden need to take a trip and get away from things. Whatever the reason that I want the money, it's a private reason that you can't necessarily demonstrate to the bank to document that you want the money. But it's valuable for me to have the ability to take out my money if some opportunity comes up that is going to make me want the money. And so that's what the feature of liquidity that Doug talked about. So here's a picture of Doug. His picture of us is much cooler. I'm jealous, but I'm grateful too because I like seeing that picture. I want to talk a little bit about Doug. He and I have worked together a lot. I can't remember ever having a real fight. We would have little arguments, and the arguments were about because we both wanted the research to be as good as possible, the paper to be as good as possible. So one of us would say, let's assume this, and the other one would say, no, we can't assume that, it'll be impossible to solve. Let's assume this other thing. And the first one will say, yeah, we can't solve that, it throws away all the economics, and we go back and forth. But never any unpleasantness. It was just like we both really wanted everything to work well. Just as superior co-author. Anyway, so back to the paper. So if this idea that you may want your money out, and you may want to get it out early, and it's because of a private shock that you can't document to the bank, is a notion that you like liquidity. And so when you have something that looks like bank deposits, when you can get your money out whenever you want to, that has liquidity, and you value that because you don't really know, as Doug put it, how long you want your money in, or as I'm putting it in, and both are consistent with our model, an opportunity comes up where you really value using the money more than you normally do. And so that's something that's valuable for the depositor, for the customer. But bank assets are illiquid. They pay a lot more if you leave them in. So let's say that the bank has made a loan to a shopping center and you have a half-completed shopping center sitting there. Well, the money is in this half-completed shopping center. You can't really sell a half-completed shopping center, not for very much. And so even if you write the contract with the borrower that says that the bank can take back their money if they can, they're not going to agree to giving back very much money in the middle because they're not going to have it. So in our thinking, we thought bank assets were illiquid because of information asymmetry, because if somebody comes to you to sell bank assets, you've spent a lot of time researching the loans, and you know a lot about what they're worth. You're going to try to sell the ones that are lemons. They're terrible. It's like Akerlof got the prize for the lemons model. It's exactly this kind of adverse selection. And that's why bank assets are illiquid. But in our model, we made a simpler assumption. We assumed the illiquidity was in the technology, like in the shopping center example. And the reason we did that is because that's not the most important part of the model. And it's going to serve our purpose. We worked really hard to make the model as simple as possible. I think probably professional economists think it's simple. I don't know if others do. But having a simple model is really beneficial because people have additional degrees of freedom that they can still handle. And people have added a lot of things to the model and they can still solve it. And so it's also a little bit like a crystal or a poem. We just want to have the simplest possible setting to explain the internal consistency of the economic ideas that we're talking about. Okay, so bank assets are illiquid, which means that you don't get much back if you liquidate them in the middle. Demand deposits are liquid, and there's this mismatch. Now, we assume the bank assets are riskless. That's a feature, not a bug. Some people say, I can't believe Diamond and Dybvig assumed bank assets are riskless. You know, we know they're risky. Well, it's a feature because we're saying everybody knows that banks can fail if the assets are risky. That's obvious. What we're saying is that even if the assets are riskless, and if there's enough assets there to handle the bank, if good things happen, and pay off all the depositors, then there still can be problems. We can still have bank failures. And of course, if the assets are risky, it doesn't take away the observation. There's still bank failures. So, because of this, there are multiple equilibria. There's a good equilibrium when people withdraw only when the money is needed. There's a bad equilibrium, the bank run, when everybody takes their money out, whether they need it or not. There's also another mixed strategy equilibrium in between where people randomize, but the economics of that are not really much different than the run equilibrium, so we need to talk about that. And then the other thing we talked about in our paper is what can you do in terms of policy. Some ways you can prevent people from running on the bank is that you can have deposit insurance so that people are guaranteed to get their money out whether or not there's a run. Even if everybody runs on the bank and the assets are gone, the government deposit insurance fund will pay them off. That's the thing that we think is probably most effective. In a setting where bank assets are risky, you also need for there to be monitoring of the banks so they don't take too much risk. That's outside of our model. A second thing we talked about is a discount window, like a discount window at the central bank where they give the money, lend banks money if they have trouble meeting the withdrawals. And as Doug said, that may suffer from a credibility problem. If people are unsure whether the central bank will always fund the banks that are in trouble, then that's not going to be an effective way of preventing runs. Then the third thing we talked about is the bank holidays. I found Ben's comments interesting because I actually didn't know anything good about bank holidays until I heard that comment. Basically, you can just shut down the bank and not give anybody back their money, and that defeats the whole purpose of the liquidity. It's interesting. I didn't realize that was used as a reset after the Great Depression and was actually something beneficial. But as a policy for preventing runs, it's not a good, effective policy to say, don't worry, if there's a run, we're going to shut down the bank. because people are going to just take their money out anyway. So anyway, that's interesting. As Ben said, and with a lot more nuance, several markets in the 2008 financial crisis looked just like our bad equilibria, and both Ben and Doug mentioned some other crises have this feature too. So the repo market, which is a big shadow banking market, the money market mutual funds, some actual banks ran, bank commercial paper. Those are some of the markets that look pretty much just like the bad equilibrium in our model. So Doug mentioned this paper in '86. I stand by most of the stuff in the paper. I think the description of money market funds is kind of accurate, but a little embarrassing. It says, you know, ignoring some extreme times, you can think of the money market funds as being very safe because they have normally liquid assets and liquid liabilities, but actually the extraordinary times are the interesting times, and the assets became illiquid during the financial crisis. But anyway, about this quote, basically this quote talks about shadow bank. You could think of this as a discussion of the repo market. It says that if you restrict banks too much and keep them from doing their job, we focus on 100% reserve banking because that was the topic of the conference that this came out of. But basically, if you don't let banks do your job, then some other institutions can arise that will try to replace banks in their function, like the repo market and these other types of markets. But it's risky because the bank liquidity may not be surplus liquidity, and it probably isn't. And it also can reduce instability because the new firms that move in to fill the vacuum left by banks may have runs. And so we saw that in the financial crisis. The run on the repo market was a big part of the contraction of the economy. But anyway, I like our policy piece. I think a lot of it stands up. And Doug says it's kind of a shame we haven't written more papers, but that could still happen. So we already talked about the good equilibrium and the bad equilibrium. Doug talked about, and I talked a little bit about it. Basically, if you don't need the money out, you don't run in the good equilibrium, but you do run anyway in the bad equilibrium. Take your money out. Okay, so I want to move on to talk about some of the joint papers that I did with other co-authors that had multiple equilibria. This is a paper called Adoption Externalities of Public Good. It's with Chester Spatt. Chester was my good buddy in graduate school. He's a year ahead of me and showed me the ropes. So in this paper, we have like adoption of a technology. For us, we thought about telephones or something like a standard unit of measurement. And whether you want a phone or not depends on who else has a phone. Equilibrium in this looks a lot like the bank runs model. If everybody else has a phone, you probably want to pay the money to buy a phone because all your friends will have phones and you can talk to them. If nobody else has a phone, you don't want a phone, you have to pay for it, but you don't get any benefits. And so this is very similar to bank runs models. Is that everybody else, you like to do what everybody else is doing. And so that was something that was an influence on me in thinking about the bank run paper. Second paper with Chester that had multiple equilibrium is about consumer information and product quality. And in this story, you have a restaurant that's producing food, and the higher quality is more expensive to produce. And the question is the customers, how much will they pay? It depends on what quality they expect. And one equilibrium is always to offer the lowest possible quality. You expect junk and you get junk. And so you don't pay very much. But there are also equilibria where larger quality is offered, and how much larger can be offered depends on how good the consumer's information is. So this paper was written before the internet, and so if you have a restaurant on the highway and it takes a long time for a typical person to return, or maybe they never return, then people don't have very good information. And that's why you have an alternative way of certifying quality for restaurants on the highway. They tended to be chain restaurants. So that's a different mechanism. But this is a case where the important question is about multiple equilibria. This was never published. We were silly young people. This was actually accepted at the RE Stud, and they wanted to take out a little section that we thought was really important. And so we said, no, we're going elsewhere. And we should have just said, can't we leave it in, please? We'll take out something else. Or we should have consulted a senior colleague. So anyhow, that's the way it goes. So the next two papers are joint papers with Jerry Janes. He was a professor. He was my professor at Penn, and I think quite accidentally he moved to Yale at the same time as I moved to Yale as a student with my advisor, Steve Ross. And these are both labor papers that have very similar assumptions. You have that firms have to pay not only the wages that they pay to the workers, but they also have to pay training costs. And the training costs are firm specific in our paper, but the problem would be even worse if you had general training costs that could be transferred. So the thing that's going on is that you can get an unemployment in this model, very similar to what Keynes described, because if you have some unemployment, so there are people who are willing to work at less than the prevailing wage, and you have a bunch of firms that are offering the same wage that's higher than the competitive wage would be, you may not be able to enter and make a profit, because when you enter, the people in your firm are going to have applications in at the firms that pay more, and you're going to incur a higher training cost than the other firms. So if the wage is not too much higher than the reservation wage that the workers have, then you can have unemployment in equilibrium. And this is a little similar to some things Farmer has done. Keynes says, the postulates to the classical theory are applicable only to a special case, and it's a limiting point of the possible positions of equilibrium. That's consistent with our model. We never published this or other paper because we both moved in very different directions in our careers. And he a couple years after this was on a commission studying the status of black people in the United States, and I moved more into finance, but I think these are interesting papers, so I want to give a call out to Jerry. The other paper has very similar assumptions. The difference is we have multiple wages that are offered, and you can have firms offering multiple wages. If my firm offers a higher wage than you, that costs me more, but I'll also have a lower quit rate. And there's features of the distribution that make you just indifferent. And so you can get wage dispersion. I also want to give a shout out to Carl Schell. Carl was one of my mentors, and he has his paper with Dave Cass. So in the bank runs model, one thing we thought about a little bit is, well, why would you ever, if you're going to have the run equilibrium, why would you put your money in? There's going to be a run equilibrium, you don't do that. Well, the answer is in the sunspots model. So sunspots model says if you have multiple equilibria and you have some randomness that you observe, that everybody observes, you can select the equilibrium based on that. So it could be that you only have 1% of the time when the sunspots are really big or really small, whatever they are, when you have the bank run equilibrium, then it may still pay to put your money into the bank. So that's a useful note. I also want to mention that Carl has written lots of interesting papers with himself and with his students have also written lots of interesting papers extending our paper. So it's part of the reason that people are so familiar with our paper. I want to mention a couple ideas for further work. Manju Puri has looked at actual bank runs, and at least to my mind, and with a bunch of co-authors, at least to my mind, the simple equilibrium in our model or the continuous or the multi-period models I've seen don't look so much like the equilibria in that model. I think there's some opportunities to do that. I don't think that invalidates our model as something that's useful for stability, but I also think would be interesting to get better fit with the empirics. David Pierce has a concept of rationalizability. He was a student when I was teaching at Princeton. Bernheim also has another concept. One of the things about Nash equilibrium is a little unsatisfying is that how do people know what Nash equilibrium everybody else is thinking about? And rationalizability says, well, all I can impose is really that everybody in the economy has some reasonable idea that's consistent with the reasonable ideas that other people could have. And that'll give you a larger set of equilibrium and maybe could help us to fit, for example, the empirical results of Manju. Here's some other mentors. Mike McGill was an undergraduate professor whose graduate economics course I took without any prerequisites. But since half of it was Hamiltonians and physics stuff, and I was a physics major, it worked out. He also helped me to figure out graduate schools, and these others are all mentors from graduate school, all very helpful in my career. So anyway, it's been a lot of fun thinking about the prize paper and some of the roots that, in terms of thinking about multiple equilibria in some of my earlier papers. And I'd like to thank my colleagues, co-authors, mentors. It's really great that I've been able to interact with you.
Douglas, please. Thank you so very much, Philip. And I think there are some people who want to take photos. So if you, all three of you can stand here. And we take the opportunity to give them a big applause again.